Hey everyone, I wanted to talk to you about 5 factors that make up your credit score. There's a lot of things that you may not be aware of and how these companies look at your data when they determine or factor what your FICO score is. The first one I want to talk about is the type of credit account that you open. As you can see, 10% is made up of your FICO score, so these could be installment accounts, revolving accounts, student loans, auto loans, mortgages. So depending on the consumer, that does factor into your score, but it's very minimal. Now, the next one I want to move on to is the number one question I get with consumers is, if you run my credit, will my credit go down? And generally, I give a yes and no answer. And the reason why is because, yes, it could impact your score, but it's very insignificant. As you can see, 10% is really what makes up of it for that portion. So, and the reason why I say yes is it depends if you are continuing to shop day by day. For example, a new car. You could be going to one dealership to another and having your credit pulled multiple times. So in that aspect, yes, it is going to make a difference in your score. Is it going to be a huge impact? Maybe not. The next one I want to talk about is the length of your credit history. It makes up 15% of what your FICO score is, and it's a really important aspect of your FICO score. And the reason why is because the longer you have your account established with the creditor and all your payments are made on time, the higher your score is going to get. I'll give you an example. Someone who maybe obtained credit in 1978, maybe they opened up a Sears card, a Macy's, or American Express. If they have that account still open, you're talking about a 41-year payment history. So if nothing derogatory is reporting in that consumer credit report, you better believe they're gonna be in the 800 club. And I know that's where a lot of you wanna be. Let's move on to the next factor, which is the amounts owed. As you can see, 30% makes up your credit score, which is significant. And I guess you know why that is, right? The higher your balance is with the credit limit, the lower your score is going to get. And we know why this is, and that is the creditor becomes alarmed. Your balances are increasing and the balances are not being paid off in a reasonable amount of time. So with that added balance that you're carrying over month to month, that's going to decrease your FICO score. Now, if you're paying down the balance and it shows every month, then that's going to help. But the more you pay, the better it's going to be. The last one is the most important aspect of what your FICO consists of, and that is your payment history. We all know this is the number one factor. If you're not making your payments on time, you're not going to have good credit. Everybody needs to pay their bills. Credit is the future. If you don't have credit, it's going to bog you down and it's going to make your life a little bit more difficult. The reason why, you're going to be paying higher interest rates. You're going to have a hard time finding a rental home or even buying a house if your credit's not up to par. So you'll want to make your payments on time because you don't want anything significant impacting your credit score. If you enjoyed this video, make sure you like and make sure you share this page with someone who you think might be interested in knowing a little bit more about credit. I'll see you next time.